Ghanaians believe that their transformation will not occur on the back of parties, but on the back of leadership. It's a question of leadership.
Welcome to today's edition of Alan Speaks. It's a continuation of the conversation we had last week relative to the discussion on the macroeconomic policy in the Great Transformational Plan. Today, we are going to kickstart the conversation from the currency, and I'm sure that all of you will be excited to hear what the policy says in respect of the currency. When the fundamentals are weak, the exchange rate will expose you. So let's see if the fundamentals are weak and whether or not the exchange rate will expose all of us. Honorable, welcome again.
Thank you very much.
We're continuing with the conversation.
Yeah.
I must say that the first part was extremely insightful. And indeed, you started by explaining to us how you were going to manage expenditure and control expenditure, and how you're going to, generate revenue or optimize revenue. Then looked at some other tax policies. We are continuing that conversation by looking at the currency in its current form, first of all, and how you are going to ensure that we have some level of stability. Because over the period, we've seen the currency, exchange against some major currencies, very abysmally. And so I'm sure that you have outlined some very practical means and ways that you're going to use to stabilize the currency so that for businesses and for young people who want to travel to China, to Hong Kong, Singapore, and Turkey to go and bring goods and trade and make and earn an income for themselves, to be able to so do without having to deal with, price hikes and things like that. So take us through the currency stabilization policy that you have.
Well, thank you very much. The stabilization of the local currency is extremely important.
Indeed.
For any macroeconomy, because it has an impact on other aspects of the economy. So particularly for a highly import-dependent economy like Ghana, any changes in the exchange rate would have a fundamental effect on the entire economy. And that's why the GTP is putting emphasis on stabilizing our currency. And we have very specific proposals in this regard.
All right.
First, and if you read the GTP, it becomes very clear that there are short, medium, and long-term solutions that will help us address the issue of currency stabilization. But let me start off with the long term.
Indeed.
Because the long term is important because it attacks the root causes of currency stabilization. The supply and demand of foreign currency, let's use for the purpose of the discussion, dollars. The supply and demand of dollars in our economy is what will determine the strength of our currency. So in any situation where you have so much foreign exchange coming into your economy, then the foreign exchange, the supply of foreign exchange is putting pressure on your local currency, because there's so much foreign exchange that now your currency becomes stronger than the foreign currency, let's say dollars. But anytime you have a limited supply of foreign currency, of dollars, then it means that you need to pay more dollars to be able to get 1 unit of dollar.
That's true.
So the long-term solution to stabilizing your currency is to export, because it's only through exports that you get more foreign currency. And you can only export if you are producing. And you can only produce if
there's demand.
If there's demand, but you can only produce competitively if your tax regime is low.
Indeed, yes.
And that's why
that's crucial.
The previous discussion on taxes was very important.
That's crucial.
So they all reinforce each other. But it is very important as a country, if we want to stabilize our currency, to increase exports. Number two, you have to reduce imports by producing locally goods and commodities that you import, which can be produced locally. Because once you import, you are using foreign currency to import. And so there's an outflow of foreign currency. And that is why it's important you increase the supply of foreign currency and you reduce the outflow of foreign currency by reducing your importation. And with both exports and import substitution, it's a question of production. If you don't produce, you cannot do exports and you cannot do import substitution. So in the long term, that is what needs to be done. The reason why we keep on having severe fluctuations in our currency is due to these two areas of concern. Now, but there are also short to medium term solutions. For example, in the short term, there are only three sources that you can get foreign exchange. First is through the banks, Bank of Ghana and commercial banks. And then secondly, through forex bureaus. And thirdly, through the black market. Obviously, the black market is not a legal channel. And so we are looking essentially at forex bureaus. If we don't control the activities of forex bureaus, it will be difficult for us to stabilize our currency. Because essentially what happens is that any foreign forex bureau operator who is looking to have more businesses or trying to get more foreign exchange into his forex bureau would always have the temptation of increasing the exchange rate. So if, for example, in my forex bureau today, I will give you 15 cedis to $1. The next day, if I want more people to come, I'll increase it to $17 just to attract more business. But then that is what we call speculative trading in foreign exchange. And that is a major part of what is having an impact on forex fluctuation now. And this is something that has to be stopped. But then the same under stable currency, the GTP is also proposing that we review and strengthen existing legislation to limit the use of foreign currency in domestic commercial transactions, particularly in the services sector. You know, you go to the hotels, you go to restaurants, and they're charging dollars, or the prices are denominated in dollars. That is wrong. Because once you do that, it means that the supply of dollar is leaking into private hands. Because you are collecting, you are not declaring. And at any rate, you are not supposed to charge dollars. It's not the unit of pricing that is allowed in our country. So we have to be able to enforce legislation against the use of dollar pricing for services, particularly in the services sector. But it also goes beyond that. When you export goods, you earn foreign exchange. You are supposed to repatriate the proceeds, foreign exchange, into Ghana. If you don't do so and you retain the foreign exchange in your account abroad, you are reducing the inflow of foreign exchange into the economy. And so government has a responsibility to ensure that companies that export are repatriating or bringing into the economy the full value of what they earn, foreign exchange, they earn into the economy, and keeping only the component that is required or authorized by law for them to retain. Now, so these are different aspects of the problem which leads to currency destabilization. Yes, please.
In respect of that, there's been concerns about how some big multinational companies flight currencies out. And so how would you ensure that you also kept that? Because I do know, I mean, there are some big giants in this country when they, every day I'm told that they exchange the monies and then, fly it out.
I could sense that you were hesitating.
Yes.
You didn't want to mention the names of the company.
Exactly.
For obvious reasons. Yes. There are two aspects to that. One is that every foreign company under the GIPC Act is authorized and allowed to transfer part of their dividends or income from their business in foreign exchange, because they bring in foreign exchange, and when they do business, they are authorized to send part of their profits, export, or let's say send it out. But it means that when the economy is in trouble, as we are now, the government has to have a way of negotiating with these foreign companies to moderate the outflow of foreign currency. Admittedly, they are authorized under the GIPC law to do so. But through negotiation, they can stagger the outflow so that it gives room for the government to be able to balance their books and not to have, let's say, a significant decline in foreign exchange resources. That is easy to understand. But then there are situations where some of these same foreign companies take out monies by exchanging cedis into dollars and illegally, as it were, transfer all this outside in foreign. That's what is capital flight. Because then it means that you are not legally authorized to transfer those monies.
There may be some legitimacy in transferring those monies per the GIPC law. But you and I do know that in terms of the actualization of it, people actually engage in capital flight. So for instance, if they are supposed to export, like, let's say 10% of their proceeds, they can export 50%. Who is checking? Because their plane lands at the airport and then the monies go. But also tied to that, and I'm sure you are going to expand the explanation on that, but respectfully, if you can also touch on the issue of, and I was having a conversation with one of my big men, and he said that, Kwame, if you get the money, buy gold. Because your currency, if your currency is tied to gold, it means that there will be some form of stability. So would you also consider, in maybe stabilizing the economy, if you're going to sort of liaise more with the mining companies and because we only get about 1% from these mining companies. So are we going to find a way of ensuring that we renegotiate so that we can build the economy tied to our gold reserve? I don't know whether the question makes sense.
No, it makes a lot of sense. In economics and in other economies, what is called the gold standard had been a very, I would say, acceptable way of managing your currency. But then that, for many countries, has been part of their history. That nobody really goes by the gold standard. However, for countries that produce gold like ours, it will be a perfectly valid proposal, particularly to address your currency stabilization program, that we use our gold resources to stabilize our currency only for purposes of those foreign companies, for example, who instead of transferring for fiscal cash in dollars, then to invest, or let's say, to invest in gold as against sending forex, because then it makes sense. But that is a better policy than the gold for oil policy. That gold for oil policy was clearly was a failed policy. But this is different.
Yeah.
It's different. A company that is authorized to, I say, export legitimately their foreign currency. Now, we want to limit the outflow. So we say that, okay, now instead of demanding dollars, you can use the gold that government would offer and then keep that one. So it doesn't affect the forex outflow. So that makes a lot of sense. But then that, as I said, that one is legitimate. But if a foreign company that has no business in transferring money takes the position that every cedi that they earn locally will be converted to dollars, then that is capital flight.
Okay, I understand.
Then that's capital flight.
I understand.
But on the back
and
of
that's
that,
criminal, right?
That's criminal.
Okay.
But on the back of that, you also have local companies. And basically, this is one of the biggest challenges we have with our currency stabilization. Every businessman, well, not every,
most of them,
many business people now want to keep their money in foreign currency because of the depreciation of the currency. So, in that particular case, it has nothing to do with legitimacy or not, but
for security,
reasons. They are protecting their own investments. But once you do that, it means that you are putting pressure on the dollar because you have more people, everybody is demanding dollars. If everybody is demanding dollars, then it means that
the value goes up.
The value then, yes, and the cedi depreciates. So the only reason why even Ghanaian companies will want to keep their money in dollars, and interesting, not even companies, individuals, everybody wants to keep their money in dollars just to protect themselves. But then that is unfortunate because that is panic buying. And the only way to deal with this is to have an open discussion and appeal to people not to get into panic buying, but also to be fair to those who are engaged in panic buying. When there's loss of confidence in the economy, you have no choice. People will do that. So the medium to long term solution is to fix the economy.
Indeed.
If we don't fix the economy, people will look for security and protection through the dollar. And I don't want to sound like a prophet of doom, but if the current government continues with the policies that they are engaged in now, people will continue to lose confidence in the economy, and then they will all rush to engage. Now that's the more justification why Alan should come and then restore confidence in the economy. Because look, these economic actors are rational people. If they get a sense that there's going to be a change in government and the people who are now going to manage the economy are going to put the economy on a sustainable, fast-track path, then there will be no reason to have panic buying because they can see hope and light at the end of the tunnel. So this is a crisis of confidence in the economy. That's why everybody's buying forex.
Right.
So this is how to deal with it.
It all stems from the vulnerability of the indicators that you earlier spoke about.
Absolutely, yes.
And this brings me to this issue about what was said by this current administration, and I'm sorry I sometimes bring this in so that we can compare notes.
Okay.
That they said the economy was turning the corner. And when you read the reasons why they said the economy was turning the corner, it leads you to but one conclusion, that it is because we got some relief.
Yes.
Particularly from the IMF and also the Paris Club. Think about some 34 million USD and some 600 million USD from IMF and the World Bank. And that was the basis for saying that there was some confidence being restored, back into the economy. But the question really is that if you look at the way some of these factors play out, in the stabilization of the city, does it scare you? And when you are given the opportunity, how would you be able to now marry all of these other exigencies, which ultimately have played a role in the depreciation of the city, particularly because of how maybe we have overborrowed and we borrow to only service 3 line items. We borrow to still pay our debt and we are unable to generate money internally. We overspend, we spend beyond, our means and things like that. How would you be able to marry all of these things together to ensure that we have some stable currency?
I'm happy that you are linking this currency stabilization to other macro elements within the economy.
Okay.
You see, because in effect, if you borrow and you're unable to pay, that's if you do not have sustainable debt management, that you are able to borrow to an extent that your debt becomes unsustainable, then it is also a sign of loss of confidence in your economy.
Indeed.
That you cannot pay your debts. When you cannot pay your debts, then the credit rating agencies start downgrading your economy. This is exactly what happened to Ghana. We were borrowing so much and unable to service our debt because we're not having enough foreign exchange, because we're not exporting, we're not producing and exporting, so we're not having enough foreign exchange. And if you're not having enough foreign exchange, it means that you cannot pay your debts to external creditors in particular, because those are foreign denominated debt or loans. When that happens, the credit rating agencies are constantly monitoring your capacity to pay your debts. As soon as they establish that you are in distress, then they downgrade the economy. And that's where they Fitch
downgraded.
And as soon as they downgrade, it's a signal to investors that we must take out our investments very quickly. Otherwise, our investments in the economy will be jeopardized. As soon as they start rushing to take money out, then it means that you have to have a way of stemming that outflow. But if you're unable to negotiate with them and they start taking out their money very quickly, then there's pressure for you to generate dollars and pay out to your investors. It means that they are exiting your economy at a time when you least expect.
Right.
So then that pushes puts your currency under strain. There's so much demand now. Everybody is trying to buy dollars and exit. And then that creates so all these things are interrelated.
The reason I ask this question, my question is really predicated on the fact that these vulnerabilities that you earlier spoke about, we don't usually deal with them.
We don't deal with them.
So it's a small screen approach. And then we just say, but the underlying factor for which reason we are unable to sustain, the currency is still there.
It's still there.
So I'm happy that you are saying that you are going to draw those interlinkages and then ultimately bring about, some solution that will ensure the stability of the currency. So you are saying that, yes, I've seen the problem.
Yes.
And I've seen that we don't have the solution to dealing with those problems, we only create a small screen semblance of some solution.
Absolutely.
And then underlying that,
we still have the fundamentals. That's where the fundamentals of
it's like Pintimamento.
That's where the fundamentals of the economy come in. That if the fundamentals are weak, the currency would expose you. That's exactly what it means. And what are the fundamentals? The fundamentals are that you are not producing enough, and so you are not exporting enough. You are importing things that you can produce, so there's an outflow. There's a problem of loss of confidence in the economy, so everybody's rushing to have, to buy dollars and keep money in dollars. There's a challenge also with the fact that those who are exporting are not bringing in the foreign exchange into the economy. So once you don't have structural transformation of the economy, where production is vibrant and you are exporting, then there's no way you can stabilize the currency. This is all coming together. And that is why the GDP is very comprehensive about
Beautifully
this.
so. I'm going for this quick break. When we come back, I'd like you to look at low inflation, low competitive interest rates, and then debt sustainability management. These are three different but interrelated areas of the economy that I think we should look at.
Yes.
And so quick break. Stay with us. We'll be right back.
I say, you be who know me who be when I say, the echoes of the S when I say, be the quest of Baba you may I say, the reference of the jar I say, Alan Cash I say, the this car calls upon wine I say, and the car I say, that's a blue and I say, never play balu I say, my in the bride I say, everything I do I say, before shine your eye I say, before you shine your shoe I say, go I won't nine it I say, you want to work on boo I say, hey, I say, I say, Munjai I say, I say, I dey come like Alan Cash, Alan Cash, plenty money for my bank, for my bank, I say, I say, I say, Munjai I say, I say, I dey come like Alan Cash.
Back. So, Honorable, yes, before the break, I told the viewers that we're going to be looking at three items. If you can quickly take us through those three items. Yeah.
Inflation is also one of the fundamental components of the macroeconomy. And basically, it is the rate at which prices of goods and services increase. The reason why inflation is important is that if you have a high inflation regime, you reduce the purchasing power of consumers. If prices are high, it means that if you were able to buy 10 units of a commodity, as soon as prices increase, you'll not be able to buy the same 10 units, you buy 5. Now, if you are able to buy 5, only 5, it means that you are reducing your purchasing power and by extension, your demand.
Indeed.
So if you reduce demand, there's no incentive for producers to produce, because if they produce, people will not buy because prices are high. And if those who are producing cannot produce because there's no demand, then they cannot employ. In fact, they may lay off people. If they lay off people, then you lose jobs, and then government can also not earn income from direct taxes or pay as you earn. So all these things affect the economy in a very significant way. And that is why inflation must always be kept at a minimum level. That's what we call taming inflation.
Okay.
But the challenge always has been, how do you actually tame inflation? Because I think, was it in 2022 or thereabout, inflation went as far as to 54%.
54%, yeah.
Now, if you have
this was in 2022,
54% inflation,
yeah.
I mean, basically you don't have an economy.
Yeah.
Now, even though that level has now declined significantly, you still have what I call a very high regime of inflation. And so what the GTP is proposing to reduce inflation is, number one, fix the foreign exchange rate for the importation of strategic commodities at a rate that does not run parallel to the prevailing market rate. So, for example, what are strategic commodities? Petroleum products. You have no choice. You have to bring in petroleum products. And it's imported. You have to bring in essential drugs. There are so many medications that we cannot produce here. These are strategic commodities. You have to bring in commodities like sugar. Because unfortunately, we don't produce sugar. You have to import sugar. Now, because these are strategic commodities that we cannot do without, in a sense, if you allow the market rate of a depreciating currency to determine how you bring in these strategic commodities, then obviously the prices always go high. If, for example, the exchange rate now is 15 cedis to $1, and the cedi depreciates, and now it goes to 20 cedis to $1, it means that if you import crude oil, you have to now pay more to bring in your petroleum products. If you have to pay in more to bring in petroleum products, those who bring in petroleum products will now pass on the effect of the depreciation onto consumers, because it's not their fault. They have to pay more cedis now for one, let's say, shipment. And that then makes these commodities or the price of these commodities go up very high. Now, because we cannot produce these things locally, then it affects the level of inflation throughout the country. And that's why when prices of petroleum products go up, everything else goes up. So what this proposal is saying is that even if the cedi is depreciating, for purposes of the foreign exchange currency rate for these strategic commodities, fix it at a rate lower than the market rate.
Okay.
So if it is 15 and it's going up to 20, for purposes of the importation of these goods, retain it at 15. But for all other goods, allow the market rate
to determine.
Because these are strategic commodities. We have no choice but to deal with them. Another solution that the GTP is proposing is that if you import goods, you pay duty in local currency. So you buy a car, let's say $5,000. Now the duty you pay, if the duty on the car is 20%, then they will calculate 20% of 5,000 cedis, but on $5,000. But the duty you pay is in local currency.
Right.
So it means that you pay the equivalent in local currency for duties. Now, if the cedi is depreciating, then it means that the duty that you pay will be higher because the depreciation of the cedi is high. And so what this proposal is saying is that, yes, we understand that it has nothing to do with the importation of the item. But because the cedi is depreciating, for those who are importing goods, fix the exchange rate for a period of 6 months. before you change it. So if I import rice, let's say in June, and the exchange rate is 15 cedis to $1. Now, by the time the imported rice comes into the country, the exchange rate would have gone up to about 20 cedis. And they would calculate the duty with the new exchange rate. But obviously it means that you are increasing the cost, the local cost of the rice. So this is saying that for imported goods, fix the exchange rate for stable for a period of 6 months before you increase it. If you are importing today, then the next time that the rate is changed, regardless of how the market behaves, for purposes of the importation and the calculation of duty, maintain that same duty rate or exchange rate for a period of 6 months. That's what this is proposing.
I see.
It will significantly stabilize the prices of goods. That's where low inflation is. The third one is food inflation. There is always a way of calculating inflation. And the biggest component of inflation is food prices. So if you want to reduce inflation and have low inflation, you have to reduce food prices. You can only reduce food prices by making sure that you reduce transportation costs for carting foods from the villages to the market centers. Once you do that, the prices of food items will come down. But it's also a question of increasing agricultural production. If you increase agricultural production, the unit cost of food will come down. So all these proposals have been made by the GTP to reduce inflation. And unless you do that, it is going to be very difficult for you to maintain inflation. But last but not the least, the cost of money, that's if you go and borrow money from the banks. If the interest rate is very high and you're a producer, obviously you pass on the effect of the high cost of capital to the customers. So then if you pass it on, it means that it is going to increase prices, high inflation. So if you want to reduce inflation, then make sure that interest rates are kept low.
I see. Now, I was going to ask you whether it will not, and especially the one that you were talking about, hedging the rate.
Yes, the rate.
Wouldn't it be against antitrust policies?
Yeah.
Wouldn't it be against, because that is, I was actually.
Now you're justifying your
inclusion.
Your inclusion. Wow. You're asking the right questions.
Yes.
So, every economy has the flexibility and authority to decide how they want to manage the economy. In fact, in some economies, you can decide to have a floating or market-driven exchange rate, which we have now, flexible. But you can have also a fixed exchange rate regime. In our case, we've decided that we are running a market economy. So we allow the exchange rate to be determined by the market forces. However, we are saying that the GTP is proposing, for very specific reasons, in some cases, you fix the exchange rate only in specific cases. So it's like a blend. Okay. And in that case, you are not violating any international
So this is not knee-jerk.
No, people will tell you that, it's not allowed, you can decide what you want to do with your economy. Because the dynamics in your economy should dictate the kind of currency management regime that you adopt.
Very well. So let's look at low competitive interest rates, financing charges, and then also let's look at the debt sustainability management.
Yes.
These are two very crucial aspects that I'm happy that you have brought up. You said you want to fix the Bank of Ghana policy rate at levels that will progressively bring lending rates down to single digit within a period of 3 years in order to enhance the competitiveness of the private sector. Reintroduce the secondary reserve requirements for banks and ensure that a portion is invested in short-dated papers, which is 91-day and 182-day, at a Bank of Ghana predetermined low rate. This will immediately release relatively cheap funds to the government, which will force interest rates down. I'm reading that so you explain it.
Yes.
Then the third point here is to maintain strict compliance with regulations for fiscal discipline to reduce government borrowing. And you are saying that it will enhance liquidity for private sector financing, which will push interest rates down. The Bank of Ghana to lend 15% to 20% of banks' cash reserve ratio at concessionary rates to targeted businesses with self-liquidating transactions to be executed through banks and other vehicles. Check collusive and profiteering practices of banks in fixing interest rates. Maintain strict oversight on the fixing of financial charges and levies by banks. Allow banks to cover their foreign exchange deposits with foreign exchange reserves rather than cedis to avoid their exposure to exchange risk and thereby reduce the negative impact on interest rates and financing charges. Then you want to reform the current credit reference bureau system to improve bank customer information and thereby reduce risk associated with lending to the private sector. This will have a positive effect on lowering interest rates. Then operationalize the deposit insurance scheme to avoid the need for high reserve requirements as a prudential safety net, which is a critical determinant factor for fixing interest rates.
I'll run through this very quickly.
Right.
First is the Bank of Ghana policy rate.
Okay.
The Bank of Ghana policy rate is the rate at which Bank of Ghana lends money to commercial banks. So currently the policy rate is 29%.
Yes.
It therefore means that banks would almost invariably fix their interest rates over and above the policy rate. Mm-hmm. It only makes sense. Mm-hmm. If they are borrowing at 29% from the central bank and they add even 5%, that already takes you to 34%. So if you want to reduce interest rates by logical extension, it means that you must bring the Bank of Ghana policy rate down. Mm. And this has been a raging debate in this country over successive governments about the level at which the Bank of Ghana should fix its policy rate. For me, there ought not to be any argument. If you know that you bring the policy rate down, it would have a multiplier effect on interest rates. Now, what is your problem? Bring it down, and then the banks will have to follow. Because even if through shock therapy, you artificially brought down the Bank of Ghana policy rate, let's say to 10%, it means that interest rates will not go beyond, let's say, 13%. Because they are borrowing from the central bank at 10%. If they mark it up by 3%, you are 13%. If they go further down, you come to a point where banks will now charge single-digit interest rates. And that would be great. The only reason why the Bank of Ghana will convince you that that will not work is that, in their view, they are increasing the policy rate for purposes of what they call reducing money supply, which is for them an inflation targeting measure.
Mechanism, yeah.
That they reduce money supply by increasing the policy rate. And then once they reduce the money supply, then people will put their money into the banks, and then obviously that automatically means that inflation would come down, because they are trying to, the argument is that we reduce excess money in the system. Because, the basic principle in economics is that if there's too much money in the system, then there's too much money chasing few goods. And that is what increases prices. So reduce the money supply, and then it will bring down.
Is it not ironical, considering the fact that Bank of Ghana usually prints money when there's no money in the system, prints a lot of it in circulation. In fact, that's even a major cause of inflation.
That's more inflation.
That's more dangerous.
That's more inflation than this approach.
Yeah.
But it has been an ongoing debate. The Bank of Ghana continues increasing the policy rate, with the argument that is the only way they can suck money out of the system and let interest rates come down. But it's not working. It is not working. So what we are proposing is that once you increase the policy rate, then banks will also increase their lending rates. Once they increase their lending rates, they will pass it on to consumers. That fuels inflation. So we are either increasing inflation rather than reducing inflation.
On the sidelines of this, when you become president, would you restore the licenses of the banks that were closed?
Oh yes, I would, to the extent that in the first place, it was not a prudent policy at that time to have withdrawn the licenses for a number of reasons. One, these are local indigenous banks. Yes, there were certain infractions on their part, not following the regulations of the central bank. They needed to be reprimanded. But by withdrawing their licenses, you have created a more serious problem, as has happened. By all means, get things done properly, sanction them, but not to withdraw their licenses. What has happened now is that government had to borrow 21 billion Ghana cedis to clean up the financial sector. Does it make sense to borrow to clean up a system when, if you had allowed them to operate, you only needed 9 billion cedis to sanitize the system? Now, you withdraw their licenses, it leads to so many
unemployment,
dislocation for businesses that were relying on these, But the fact that you had to borrow to fix that problem in itself, I think,
was a big problem. Not just by the way.
But I think it's important. But I think that this issue of inflation targeting by the central bank is one of the reasons why interest rates are still high, because that is the benchmark rate that banks use, apart from treasury bills. They use the Bank of Ghana policy rate and treasury bills, the rate, treasury bill rates, to determine their interest rates.
Okay.
So bring it down. The second thing, as you read, was that there's what they call the secondary reserve and primary reserve requirements of the banks. Can you imagine that currently the primary reserve requirement requires banks, commercial banks, to put 25% of their deposits in the central bank with no interest paid? You mobilize deposits from customers, and you are required to put 25% of this money in the central bank, and it is not touched. So a bank then loses 25% of their deposits. If they lose 25% of their deposits, it means that out of the monies they've collected, they only have 75% that is available to them to lend. So to be able to pay interest on deposits, which is why people have put their money there. They have to now increase their interest rates to earn more, to make up for the 25% that the Bank of Ghana has withdrawn from them. So, the Bank of Ghana is doing that again to reduce money supply. In their view, this is what is causing inflation. But by doing that, you are increasing interest rates. Because if you take 25% of deposits from banks and you put it there, it doesn't earn any revenue. For me, it is counterproductive. So what in fact we are saying, there was also something called the secondary reserve. Apart from the primary reserve, there was also the secondary reserve, all designed to suck money from the banks and from the public. Although that secondary reserve requirement has been eliminated, we are saying that then rather introduce the secondary reserve, add it to the primary reserve, so you may have not 25%, maybe you now have, let's say, 30%. Now use that 30% which is lying idle with the central bank. Lend that money, because it's lying idle. Lend money to government at, let's say, 5%. If you lend money to government at 5%, because the money was not doing anything anyway, then it means that government itself, instead of borrowing at 25% from the market through treasury bills, now has access to cheap funds. Once they have access to cheap funds, then it is reducing the debt burden on government. So this is all practical economics.
Right. Also on the side, the lines of that is the issue about increment of goods and services as a result of inflation.
Yes.
And the fact that the reverse is not the case when inflation is coming down. So for instance, you made reference to inflation hovering around 54% in 2022. Now it's hovering around 20.9%. But if you look at between the time when it was around 54% till now, the price of a bag of cement has shot up from 65 Ghana cedis to right now 104 Ghana cedis, depending on the brand that you are buying. Some 107 Ghana cedis.
Okay.
So how do we ensure that there is that symbiotic relationship between the increment in and the decrement of inflation, and then juxtaposing that with the prices of goods and services on the market? Because for the average consumer or for the average market woman, I think what makes them excited or their determination of inflation is the price of goods and services for them on the market and then at the fuel pump. So how would we be able to marry all of that? Because I know that you will be able to deal with the issue of inflation, but how do we also measure that in terms of how that will affect price change and price mechanisms?
Well, if I understand you, once you deploy some of these measures to reduce inflation, as long as you have an unstable exchange rate and a depreciating exchange rate for selected commodities, then you have that problem still on your hands.
Indeed.
Because cement, whether we like it or not, like petroleum products, is a strategic commodity.
Okay.
So you are managing inflation through viable policy interventions. But if you don't manage your currency well, then it is defeating the same purpose. It is diluting all your efforts at reducing inflation because of the high import dependency of Ghana. So this is it's almost like a trade-off. You reduce inflation through the measures we are discussing, but you also have now to stabilize your currency and you have to reduce your interest rates. And so it takes us back to the same measures for reducing interest rates as you read. One is also the other one is to check collusion and profiteering by banks in fixing interest rates. It is something that is an unknown secret. that in respect of fixing of interest rates, the banks will always huddle around a certain, I would say, range. And obviously, government and the Bank of Ghana have to check that. But it's not just the interest rates. It's also financing charges. Because there's evidence that, again, they can work together and agree that they will impose some financing charges, which for many customers undermines their own interests. And again, we've talked about also reforming the current credit reference bureau. Part of the reason why interest rates are high is that the banks claim that the risk associated with Ghanaian companies is very high. They borrow, they don't pay. And so they have to increase their interest rates to cover the risks associated with lending to Ghanaian companies. So if you want them to reduce interest rates, you have to reduce the risk associated with lending to Ghanaian companies. And one of the ways to do this is what is called this credit reference bureau. You go and borrow money from Stanbic, then you don't pay. Next time you go to APSA, you don't pay. Next time you go to CalBank. Now, when you do that, it means that because there's no information on you, you run from one bank to the other, deceiving them. But the Credit Reference Bureau would publish information on your credit reference. So the banks, your credit score. So the banks will know that this guy is a dangerous. That was the credit reference bureau. That's what it is.
Yes. Okay. But the final one, you want to operationalize the deposit insurance scheme. Can you explain that?
Because as I mentioned to you, the Bank of Ghana requires you to deposit some of your or let's say to put some of your depositors' money as reserve with them. It's all to make sure that in the event that you collapse, then there's a reserve in the central bank to pay your customers. Now, so this proposal is saying that don't justify the policy to take money from the banks and keep as reserve by saying that, it will cover events of a bank collapsing. So this proposal is saying that there's a deposit insurance scheme that when banks take deposits from customers, you can take an insurance on the deposits. In the event that something goes wrong and you cannot pay, people come for their money and the money is not there, then the insurance scheme will cover it. If this was being applied, then the banks whose licenses were withdrawn, they could have used the deposit insurance scheme, because the only reason why their licenses were withdrawn was that people were going for their money and they were unable.
Or so they claim.
So if there was a deposit insurance scheme,
that would have covered for it.
Yes, invoke the insurance. And there'll be no need.
Going for another break again, there are about 5 key items that we've not dealt with. Debt sustainability management, increasing financing for small and medium enterprises, reforms in cocoa sector financing, deepening of capital market and financial intermediation, improving labor productivity. These are key areas that we have to tackle before we exit. Quick break. Stay with us.
I say, you be who know me who be away. I say, dear cause of the air, so when I say, obi the coins to buy you may. I say, the ref is a bit jarring. I say, Alan Cash, I say. In this car, call us up on wine, I say. And the car labash, I say. That's a blue and the bar, I say. Never buy balu, I say. Buy in the bride, I say. Everything I do, I say. Before shine your eye, I say. Before you shine your shoe, I say. Who I want nine it, I say. You want to wear bamboo, I say. Hey, I say. I say. Munjai, I say. I say. I dey come like Alan Cash, I say. Alan Cash, I say. Plenty money for my bank, I say. For my bank, I say. I say. I say. Munjai, I say. I say. I dey come like Alan Cash, I say.
Back, and you're still watching Alan Speaks Primetime Show. My name is Kwame Owusu Daso. We are still looking at the macroeconomy policy in the Great Transformational Plan. And we're going to be touching on a few other items therein. What we're going to be looking at is debt sustainability management, how we manage our debt and how we sustain our debt. Honorable, can you take us through that?
Thank you. For a very long time, over successive governments, Ghana has been caught in what I'll call a debt trap, not debt or death, but debt trap. We keep on borrowing to finance consumption. We keep on borrowing to finance capital expenditure, which is unnecessary. We keep on borrowing to service our debt to the extent that we pay out of the revenue that we collect. We pay almost everything that we collect to service our debt and to pay salaries, and nothing is left. So it means that we are overborrowing. And that is a policy failure. It can be described as reckless borrowing, because once you borrow beyond a certain limit, then it's reckless. Your debt is not sustainable. And so what the GTP is saying, because of the effect and the impact of excessive debt on the entire economy, the GTP is proposing that we have to limit government borrowing or debt to GDP to not more than 55%. Currently, our debt to GDP ratio is 105%. And that was one of the conditions imposed by the IMF when they started discussing the restructuring. Initially, the government was putting the debt to GDP ratio at around 80%. During the initial discussions with the IMF refused to accept that, I would say, those numbers, and requested Ghana to consolidate all other debts, including arrears, also the debt of SOEs, including Cocoa Board, ECG. And when we consolidated all those arrears and debts, it took us to 105% of debt to GDP. Wow. And the IMF then imposed a condition on us that for them to lend to Ghana, we have to reduce that debt to GDP from 105 to 55%,
right,
before they can lend to us. So that is what led to the domestic exchange, and all the other intervening circumstances. So we are imposing a limit on the country not to go beyond 55%. But how do you do this? So we are saying, for example, that we must shift government's focus from borrowing to finance capital expenditure, including infrastructure, to incentivizing the private sector to rather finance,
invest in capital expenditure,
finance and invest in capital expenditure, including roads, airports. Why is government believing that they always have to borrow to finance infrastructure where you don't have the resources, and when you can incentivize the private sector to do exactly that? So our proposal, which is based on the concept of an enterprise economy, which is to put the private sector at the center of your economy, requires that you allow the private sector to finance capital expenditure and relieve the government of the burden of borrowing, which increases our debt. It's a major condition. In fact, to sum it all up, that's where it all ends. Bring the private sector in, allow them to bring in their foreign capital to finance capital expenditure, and you rather regulate the transactions that they will be engaged in. So if it's roads that they are building, you regulate the fixing of road tolls, and that's the only sustainable path for infrastructure development. And it also talks about
enhance government's revenue
if we
from exports.
If we produce as the GTP is proposing, and we export,
generate more revenue.
You generate more revenue, so you don't need to borrow. Clearly, it is not complicated. It is, I think, field policy interventions that has led to what currently now is unsustainable debt for Ghana. Increase your exports, increase your exports, get more revenue. When you get more revenue, you can use your revenue because it's export proceeds. So you don't need to borrow forex or foreign exchange because you are earning more revenue from exports. How can this be complicated? So we are not thinking right in this country. And for me, that's, and then we are talking also about making sure that we refocus government's debt management strategy from borrowing from international capital markets to provide incentives for the attraction of FDI. So it's not just about bringing in foreign
direct investment.
Yeah. Once you bring that in, then you incentivize the foreign investors to increase the creation of jobs through what they do. So it's not just exports, it's also bringing in FDI to work with local companies through joint ventures and other arrangements.
Right.
It's
the VI excites me to develop a comprehensive and compelling case to support government negotiations with external creditors. You're not satisfied with the way this government is handling?
Yes, because
our debt situation.
You see, you have excessive debt. You've demonstrated that you are unable to service your debt because you don't have the money, you are broke, you don't have the export base, you don't have the international reserves, you don't have anything. Meanwhile, you are imposing a domestic debt exchange program on poor Ghanaians, pensioners, to be able to reduce your debt. So we are saying that instead of doing that, sit down and negotiate with your creditors. Maybe they'll have pity on you and then give you debt relief, which is not a strange policy initiative. During President Kufuor's time, when we assumed office, and Kufuor realized that the country was literally, I would say, broke, he was compelled on the advice of the UK, I think it was one of the British UK ministers of state, Clare Short, to approach the World Bank and ask for debt relief, not only from the institutional creditors, but also from all other creditors. So that was the basis for Kufuor's, I would say,
Epic.
success. In the beginning, once they had debt relief, it gave us the fiscal space
to breathe.
So instead of using our money, the little money we're earning to pay debt, now if the debt was cancelled or restructured, then obviously you have fiscal space. So that's what this is saying.
Right. Okay, so you want to increase financing for small and medium enterprises. And by that, you want to direct all banks to allocate the equivalent of a minimum of 10% of profit after tax. I read it when I was reading this yesterday. I was contemplating whether the banks will be amenable to it.
I'm happy that you process it right.
Yes.
So this is an argument to suggest to the banks that
all right,
we cannot have an economic regime or economic environment where 90% of enterprises, that's medium, small, and micro enterprises, they constitute about 90% of our enterprise base. So if we are unable to find a way of extending credit to them, increasing financing to MSMEs, then it means that your economy cannot function because 90% of your enterprises are without the fuel and energy, which is capital, to keep them going. So it is a contribution that you are asking the banks to make. The banks are being requested now to allocate 10% of
profit.
Their profit. Yeah. So this is saying that you've made some money, government has given you all the support to make some money. This is the banks. So part of the profit
after tax,
which you, technically speaking, are paying to your shareholders, make a case to your shareholders to allocate 10% of that profit, because this is additional money, the surplus that you have earned from working in a good, positive environment. So make a contribution to the development of the economy by lending or allocating 10% of that profit to SME. So you haven't lost the money. The fact that you are allocating doesn't mean you've lost the money. It says that you are allocating that to support SME development. And it talks about collateral-free lending, because the MSMEs cannot provide security. So it has to be collateral-free.
I'm sure
then it has to be concessionary, because the fact that you are giving them collateral-free and concession does not mean that they will not pay. So technically speaking, you are not losing money, but you are supporting the growth of the economy, which in effect, you're actually growing your own customer base. Because if they make money and they survive, they will continue to borrow from you. Or they will continue to borrow from you and also put money into your bank through deposits.
So I'm sure the bank would also like to propose to the president, Alan Kojo Chemantin, that in this same vein of allocating 10% of profit after tax, they can also suggest that why wouldn't the government of Alan Chemantin also say that 10% of your total profit before tax will also be given to you, so that you can use that 10% to loan out to people who are, rather than after tax.
No, that's another.
It's a conversation.
No, that's another entry point.
All right.
That's another entry point. Because after all, if you lend it before tax, then it's an expense. If in case you lose that money, so you can write it off, and then basically it means government then agrees that that part of your profits before tax. That will be taken into consideration if your tax assessment is being made. So that's another entry point.
Right.
Yes.
Makes a lot of sense.
Yes.
Makes a lot of sense. And then the other aspect of it is to also facilitate, provide regulatory capital incentives to banks to lend to SME at concession. I think you have explained that.
Yes.
And then also to facilitate the setting up of bank loan recovery courts.
Because when people borrow, they don't pay.
So we need to find a way.
We have to, and these loan recovery courts would incentivize the banks to lend, because if they lend to SMEs and they don't pay, they don't have to go through the hassle of chasing after them. There are dedicated courts which will help them recover their monies.
So makes a lot of sense.
Yeah.
The Ghana incentive-based risk sharing system for agricultural lending, Development Bank Ghana, Exim Bank, etc., to channel in the short term 50% of their support interventions to targeted general manufacturing operations with high potential for growth, and also to broaden local content legislation to support the growth of SMEs and thereby make them more attractive for bank financing.
Yeah, it's very simple.
Right.
What this proposal is saying is that there's an existing financing scheme supported by government, which is directed at supporting local banks to lend to those involved in the agricultural sector. Because generally speaking, banks find agricultural lending very risky. And so what government has done is to provide a guarantee fund which allows banks to have the incentive of lending to those in the agri sector. If for one reason or the other the crops fail and they're unable to pay back, they can fall on this guarantee scheme, which is the GESEL. So what this proposal is saying is that try and get this GESEL and then other government banks like Exim and CBG to now channel 50% of their funds. Exim Bank, CBG, these are all government banks or funds. This is saying that because of the importance of SMEs to the economy, channel 50% of your funds directly to support MSMEs instead of just lending it without direction. That's what this is saying.
Brilliant stuff. In the cocoa sector financing, you want to abolish the almighty syndicated arrangements that we usually get entangled with, and ultimately becomes a big wahala for Ghana. Why do you want to abolish it? And why do you want to introduce domestic securities denominated, local currency for cocoa purchases?
Okay,
yes, sir.
Every year, government borrows through syndication about $2 billion.
Yeah.
Now, ostensibly to buy cocoa. Meanwhile, we all know that we don't buy cocoa with dollars. We use cedis to pay for cocoa. The cocoa farmers are not paid in dollars. So why are we borrowing dollars to pay for cocoa when we actually use cedis? Because once you borrow $2 billion and you get a cocoa crop and you sell it, you have to use that same money to pay your debt of $2 billion. So, you are not earning anything. You have borrowed $2 billion and now you buy your cocoa crop. When you export, you have to use that money to pay off your debt. So it's in and out. You don't get anything. But rather, if you mobilize local cities to buy the cocoa crop and you export and you get, let's say, 3 billion or 2 billion, then the full value of that 2 billion comes into the economy and you don't use it to go and pay back your loan, with interest.
I get it.
It's very simple.
I get it.
It's very simple.
Right. Another thing is you want to deepen private sector participation in the cocoa sector. Are you saying that right now there's partial? There's partial, okay.
Because the buying companies, local buying companies, are mostly private sector.
Okay.
Apart from PBC, which is a produce buying company, part of the cocoa board architecture. Almost all the others are private companies. But that is not enough. If you go to Cote d'Ivoire, it's almost completely privatized. And that probably accounts for the reason why they have a much bigger crop. And all that this is saying is that try and get additional capital into the cocoa sector by offloading part of the cocoa board shares on the stock exchange, so that
I can buy some.
My nephew here, you can also buy some and earn some good return on if indeed is the commodity that keeps the economy going. Then allow cocoa farmers and ordinary Ghanaians
to have shares in their own,
to buy shares in cocoa board. It provides additional capital for cocoa board so that they don't even need to borrow. They don't even need to borrow, because you are now recapitalizing cocoa board by putting part of the shares on the stock exchange.
Right, makes a lot of sense.
And can you imagine a situation where cocoa farmers now own about 20%
of cocoa board? Yeah, that would be significant.
Yes.
Actually. So you want to,
and then the last thing in the cocoa sector is that if indeed cocoa is the mainstay of the Ghanaian economy, how is it that the accounting for cocoa finances
is
separate from government finance?
Yeah. So the balance sheet, you want to
you want to consolidate
the balance sheet.
The reason why they've kept it that way is that they don't want to account for the cocoa business to government. Cocoa board does their own accounting, their own balance sheet. Nobody can peep into it. Whilst government literally is 100% shareholder of cocoa board.
Yeah.
So this proposal is saying that try and get the balance sheet or the accounting for cocoa to be part of government accounting.
Yeah, I've seen that. That's brilliant. Now let's move to the area of deepening capital markets and financial intermediation. And you say that you want to recapitalize all existing viable state-owned enterprises by offloading a minimum of 40% of its share capital on the Ghana Stock Exchange and other external markets to private sector shareholders, including introducing employee stock options. You can also privatize all non-viable SOEs and channel proceeds into the establishment of a new Ghana Sovereign Wealth Fund.
If GNPC, if VRA, if ECG, if all the state-owned enterprises that are known to be profitable, for ECG is not, but the ones that are profitable, why is government keeping all these shares when you need additional capital to reinvest in these companies? So this is saying that offload a minimum of 40% of GNPC, of VRA, the viable ones, offload them to the stock exchange and allow ordinary Ghanaians to put in money. It's very simple. You get additional capital, and then you also gradually reduce government's shareholding interest in these SOEs. But for the non-viable ones, the case is even more obvious. If it is not viable, why should government continue holding on to it? So sell them off.
All right. And you want to consolidate all existing statutory investment funds and other funds. Example, the Stabilization Fund, the Heritage Fund, Minerals Income Investment Fund, the Ghana Infrastructure Investment Fund, Venture Capital Trust Fund, etc. Under the Ghana Sovereign Wealth to be established. Why do you want to establish a sovereign wealth?
You know,
There's this sovereign fund that was created.
Sorry?
The sovereign fund that was created.
Yeah.
And now we don't have it. I think.
No, we don't have it.
Yes.
We don't have it.
This
but
administration.
In all the matured economies of the world, they have a sovereign wealth fund.
Yeah.
And what a sovereign wealth fund does is to put all the accumulated profits that come to government, to put that into a fund. And that's what is called the sovereign. So all the money that Ghana would make, you put it into a fund. And then you can use that fund to finance intermediation, financial intermediaries like venture capital companies, all these leasing companies. You see, a venture capital company will lend to young entrepreneurs, startups who have bright ideas but don't have equity and don't have collateral. A venture capital company would rather put in equity into a business that has been established by a young person, bright idea, but he does not qualify for normal bank financing. No bank will look at that business plan. But if you have your excess profit from government transactions, if that is put in a wealth, so it's government's money, it's Ghana's money.
Right.
That's the sovereign wealth fund. And then you can use that to capitalize new financing institutions like a venture capital company that we can use to support startups, young people, and other things.
Time flies when you're having fun.
Okay.
Where our time is actually up, but I will plead and still maybe 2 minutes and look at the final aspect of this document, which has to do with improving labor productivity. And maybe just
labor is the most important factor of production. We know. And if we want to improve our economy, the macroeconomy, the GTP is saying that we have to make sure that we introduce interventions that will increase the productivity of labor in both the public and the private sector. It's also saying that the cost of labor from the public sector as a component of public sector expenditure. We talked about this. It is too high. And we have to reduce the cost of public sector not compensation in terms of reducing their salaries, but the amount of money government spends on public sector wages, which means that we need a more efficient public sector. And then it also talks about appropriate skills required for optimal performance of labor. You need to improve technical skills so that labor will become more productive. If labor is more productive, you earn more from both the public sector and then the private sector. So that's all that this is speaking to. And it's very, very important because if your labor productivity is low, then you cannot compete. It means your cost of production will be high. Your productivity is low. Your cost of production will be high. And then you cannot compete.
Because you can't even export. You can't generate internally to feed yourself.
Absolutely.
Exportation.
Much more export.
Thank you very much. It's been a marathon, pleasure. But I think that it was worth it.
Yes.
And
I must commend you. You've done a good job.
Thank you.
In processing all the
for the benefit of our viewers, I think we need to read more around it so that we can explain it to them better. This is what I stand for, to be honest. I mean, it's not enough that you tell us what you intend to do, but the how. And I'm happy that you're explaining to us how you intend to achieve what is in your policy. So thank you for, even hatching this concept of Alan Speaks and giving us the opportunity to also ask you questions on your own show. So thank you very much.
Thank you very much. And I appreciate it.
Yeah. Viewers, this has been Alan Speaks Prime Time Show. My name is Kwame Owusu Danso, and I trust that you've enjoyed the discussions on the macroeconomic policy in the Great Transformational Plan. We'll see you next week. Have a nice day. Bye-bye.
Ghanaians believe that their transformation will not occur on the back of parties, but on the back of leadership. It's a question of leadership.
Welcome